Okay, let's sort of switch gears a little bit and switch to what we refer to as exchange traded funds. Again, these are tradable fund shares. They're typically what we might refer to as an index fund. They can be traded on the market. Again, only at the end of the day. Um, the first one was Standard and Poor's Depository Receipts. These were referred to as spiders. Uh, but now there's like over 1,000 of these ETFs. They give us diversification, low cost, low taxes. Some intraday actually buying and selling is possible, right? So these some of these refer to what we refer to as something as a closed-end fund. They combine the features of stocks and mutual funds. In fact, the Spider um, lets you invest in the S&P 500 and trade throughout the day. So ETFs are often have much lower fees and greater flexibility than mutual funds. However, they are typically more geared towards indexes. So if you would like to invest in something different, if you want to invest in something that pays more income, you may want to move towards some type of an income equity fund or a dividend paying fund. But your strategy is could be these exchange traded funds, allows you to follow the stock market. One of the challenges, though, with this ETF trading is the pricing mechanism. Sometimes they will sell at a discount. They're selling for less than the NAV, which means you're buying it for less than what the value of the portfolio is. Might be reasons for that. If people do not think that that mutual fund is performing well, then the demand will be down and price will be down. You could buy them at a premium, right? Why would you buy one that's worth at a price higher than its value? Because it does really well, earns high rates of returns, and you think you're going to get your money back. So, one topic that we haven't mentioned all that much yet is something called arbitrage. Uh, this is really kind of it's a strategy where you're buying and selling securities in different markets to try to take advantage of different price differences. Um, Institutional investors frequently use what they refer to as arbitrage between index stocks and the ETF to try to remove any of those discounts or premiums. So, again, these funds typically trade like stocks, where the price is based not just on the NAV, but also on supply and demand for the fund. So now again, there are these arbitrage opportunities or opportunities to take advantage of price differences. So what is this thing that we refer to as an ETF tracking error? Well, this you want to understand how well is the ETF actually following the index. This gives us a picture, if you will, of the performance. So while it mimics the index, it may not be exact, right? They're not going to actually buy 500 shares of the S&P 500 or 500 stocks. They're going to buy something that mimics it or tracks it. So we would like to know what the error is in that. And we can do that by you find what is the tracking error for one period is the difference between the NAV return and what the benchmark earned. So you take the spider's rate of return, subtract that from the rate of return on the S&P 500. That's the error. And if we look at that over time, we're looking at the standard deviation. What is the riskiness of this error? So there's always going to be some error. And here we have an example of how we could do this. If you wanted to do this by hand, obviously, you could follow these directions, right? Here's the NAV return, here's the index, there's the difference. Then you find the average error, the difference, square the difference, and we do our calculation down here. So the average is negative 0.04%. Now, if you look at the standard deviation of those differences, the standard deviation is the standard deviation of this column. we see that that is 0.0001, very low number. So again, relatively speaking, that looks pretty low to me. We might think that this particular exchange traded fund is tracking the index fairly well. Now, one of the things that we can do with these ETFs, since they sort of act like stocks, we can also have what's referred to as a leveraged ETF. This is where they could use debt, or they could overweight, um, or use derivatives even to help magnify returns on the index. A short ETF invests to have a return in the opposite direction of the index. So it kind of is a contrary view of what's going to happen to the index. So again, these are just versions. Quite frankly, I think more uh, advanced versions, of course, of these ETFs. I would suggest that the average investor should uh, stay away from these more um, different types of advanced types of investments. Now, closed-end funds, again, are very much like ETFs, except the number of shares can't be changed. So in the very beginning, they decide what they're going to invest in. They create a portfolio. They create a number of shares. So this closed number of shares can't, it can, the number of shares itself doesn't change, but the values within does. So that means that these funds, again, can go above or below that NAV. Excuse me. So the price difference, right, is likely due to differences in demand or active management, maybe, of the mutual fund itself. A unit trust, again, is a specific type of closed-end fund. Again, this is typically a passive fund. They buy the assets and they just hold them, with very few purchases, and in rare instances would there be any sale of the assets. Investors typically pay 3 to 5% when the trust is formed, and then they pay management fees to trustees. We have something called a hedge fund, and I like to make a distinction. These, for me, these are not really mutual funds. Mutual funds have embedded some diversification, etc., that implies some lower risk types of investments. Not no risk, but less risk. Hedge funds are just the opposite of that. These are actually limited partnerships, and they use high risk methods trying to seek funds. They're private organizations, and you have to be a special kind of investor to invest in these. In fact, you have to have at least $1 million to invest in the fund. I mentioned they use risky investment strategies that generally aren't allowed in a mutual fund. Hedge fund managers are well compensated, often with a 2% fee and 20% incentive fees. Often have lockups where investors can't redeem their shares. There's no secondary market for these funds. They are, by definition, a high risk version, if you will, of a mutual fund. There are also private equity funds, that firms that we can invest in, that work similar to investment companies. These are private investment companies that purchase, operate, and resell companies. Right? So, they might purchase a company, aggressively cut costs to make the company more profitable, then sell it to another company or take the new company public. They can be very profitable. Um, they can also take a company private just by purchasing all the stock. Right. So these private equity firms are an investing vehicle where this company invests in buying up other companies and selling other companies, and you can invest in those firms. Now, there is a type of a closed end fund I think we need to talk a little bit about, just because it has to do with real estate. And real estate, from time to time, can be a rather profitable kind of an investment. So currently it says there are about 225 of these REITs, real estate investment trusts, that trade on the New York Stock Exchange. The deal is they must distribute at least 90% of the taxable income each year as dividends. So if you invest in one of these investment trusts, you're going to get cash flow distributions throughout the years. You're going to be getting a positive return from this. Now, there are different types of REITs. An equity REIT owns real estate, they actually own the property itself. Mortgage REITs, they lend money to owners and developments for them to buy the real estate. And then we have hybrid REITs that use both equity and mortgages. So the point is, they are investing in real estate. And if you have an interest in buying real estate, this could be a great place to put some of your money. How do the returns of these seem to work over time? Again, if you look at the red line here, this is I'm not sure what NAR right National REIT is here. It's all of them. If you look at pretty steadily go with a pretty decent growth over time. Here is the S&P 500 that shows that REITs do have some growth. But again, what did happen in 2008? You know that there was the bubble burst. But since then, growth has been fairly substantial. Looking at again the gray line is the equity REITs. The orange line are the mortgage REITs, and then again the red line there is the combination of everything. So we have seen some pretty substantial growth in these REITs. So if you want to invest in you can just invest in REITs. You can invest in the stock of companies that are heavily invested in REITs. You can invest in real estate focused mutual funds or ETFs. You can buy mortgage backed securities from Fannie Mae or another government organization that provides loans um, or money so that banks, etc., can offer loans to consumers. So there's lots of ways that we can ultimately invest in real estate. Again, hope you've gotten something out of this video on mutual funds. Look forward to seeing you next time.